So Steve is a longtime friend and colleague. He's now the Franco Modigliani Professor of Finance at MIT, and previous to that, the Sterling Professor at Yale. He's president of the American Finance Association and has gotten prize after prize after prize, and you can read about them in the bio. He's also one of the pioneers of modern finance. We don't tend to give you enough credit at MIT, Steve, because when you were doing this pioneering stuff, you were not at MIT, right? And but you can look at the arbitrage pricing theory, APT, the Cox-Ingersoll-Ross theory, the first really successful modern treatment of the term structure of interest rates, early work on signaling and agency. His research CV is protean. It goes amazing breadth and imagination. I'm thinking that I don't know whether this is quite the right phrase, but as far as research goes, Steve is a bottomless pit of inspiration. And he's also the author of a competing textbook.
I'm a relatively new face at MIT, but I just wanted to say that this place is truly infectious. It is both a pleasure and a privilege to be here. I'm going to talk to you today about predicting the market, and if any of you think you can actually do that, you're going to turn your degrees in at the front desk. But I can get you further along than I ever thought it would be possible to do, and that's been a pretty exciting piece of work that I've been involved with for the past couple of years. I have more slides than time, and that's okay. That's usually the case. But the slides are available to you, and I just want to get through it pretty quickly with three basic points. First, I want to tell you what exactly is the problem, what exactly is it that I'm going to be doing. And second, I'm going to tell you how I do it and what the theory of this is. And that's one of those corners of Stu's triangle is theory. And the third is I'm actually going to apply it, and I'll show you a practical example of what I'm doing and how it works. So here are a collection of the questions that we'd like to know the answers to, some of which we actually have the potential to understand. First, we'd like to know the equity risk premium. We use this for everything from capital budgeting to pension planning, actuarial analysis, almost every one of the long-term issues that we face, some of the government issues that were decided earlier, the viability of Social Security. Issues like that depend upon the equity risk premium. We don't seem to know what that is. It's unfortunate when things depend upon something you don't know the answer to. We want to forecast market volatility. That's an important thing. The probability of a crash or a boom. I agree with what was said earlier. No one really knew. I guess that's not true. I had many people who told me that a crisis was coming, and they were the same, just like that clock that's right twice a day and it stopped, you know. But I actually knew no one who had any sense of how it would spiral out of control and what the actual implications of, for example, crash in housing prices would be. We'd like to know the actual probability distribution of future returns. One of the nice things, by the way, of giving a talk to MIT people is you don't have to explain what that is. You folks know what that is. We need to know this distribution for a lot of reasons. Another thing we'd like to use it for is risk control, VAR computations, value at risk. And when an insurance company says that they've planned so that they're going to last and have only a calamity that occurs once in 100 years, bring them down, how do they know that? How did they estimate that probability? We could use this distribution if we had it. If we actually knew the future probability distribution, we could use it to test whether someone who claims to have an alpha strategy that beats the market really does. And here's the seductive thing, and it's been important to me since I began in this field. You know, financial markets, securities, price cash flows that go into the infinite future. So the hope has always been that somewhere locked up in those prices is, if not the prediction of what the market will do, at least the market's forecast or the market's prediction of what it will do. So what I'm going to do in this talk is I'm going to give you a new technique for trying to solve these questions. And I think it's interesting because of what it doesn't use. So you'll see all the things that don't go into it, and it's pretty stark in the only information that it does use. All it uses is prices in the marketplace to predict, or at least to unfurl, I call it recover from that, what the market thinks will happen. So we already do this in the bond market, and we do a terrible job of it. We use prices to tell us about the future, and here's where some slides will come in that I'll skip quickly through. We use forward rates. So I look out on the yield curve and I look at the 1-year forward rate, 2-year out. And that forward rate is sometimes used as a prediction of what the 1-year rate will be in 2 years. Of course, it's a terrible prediction. We don't know what kind of a prediction is. We don't know anything about how it relates to what the market thinks is the distribution of returns in the future. But we use it. It's at least something that we do look at market prices and say that tells us something about what's going to happen. What we typically do is we form our own models and forecasts and at least compare them with forward rates. I don't know anyone who operates in the fixed income markets who doesn't use forward rates as at least a benchmark for what they're doing. I'll skip that one because that just shows you how a forward rate does. Here's what we'd like to do in the bond market that we don't. Forward rates are only one prediction out of the universe of possible interest rates that could occur. What we don't do with bond prices, and what we should do, is answer a richer set of questions. I mean, I want to know now, is this yield curve that we have today with interest rates effectively zero at the bottom, are we going to climb at the short end? Are we going to climb up that yield curve like it says in the next 2 or 3 years? Are we going to get to those forward rates as the spot rates 2 years from now? Or is this curve just going to slide along? And more precisely, what is the probability that those things will occur? I don't know that by just looking at a forward rate. We need more than forward rates. We need something like contingent forward rates. And contingent forward rates would be rates that said, if the market goes up to say 5% in its yields in the next year, then it'll do something afterwards. We want to know sort of the if-then, those contingent prices. And there's an example of it. A rate that I could lock in for a 1-year investment 2 years from now if the 10-year rate is 6% 2 years from now, rather. So here's what we do in equity markets. That's what we do in fixed income markets. Here's what we do in equity markets. We do nothing. We don't even ask the market for a single forecast like we do with forward interest rates. Here's what we do. We use historical market returns and the historical premium over the risk-free rate, and we say that's what's going to happen going forward. And we don't know if that's consistent with what the market thinks is going to happen. So if you skip to the back, the last thing we do, the third one down there, what we do is we survey participants in the market and say, what do you think was going to happen? Yeah, I took this, that was the first sign I had that this would be a useful bit of research to do, because people kept asking me what I thought was going to happen. I knew that was not, people asking me what the market's going to do, and then averaging out people like me who answered their question. And by the way, if you answer it for free, you have no feathers on what you say. So that couldn't be a useful way to do it, but that's an important thing we do. We build models, dividend yield models. We say, let's look at the price, let's look at projected dividends, let's see what the implicit yield is. That might be some estimate of the expected return. And then for those of you in technology, in quantitative finance, we use the martingale measure, those same probabilities that come out of option prices. And we say that's what's actually going to happen, or some variant of it. What we want to do in the equity markets and the fixed income is actually find the market subjective distribution of future returns. And so that's what we're going to do today. And then we can compare our forecasts with those. So it begins with the option market. Depending on who I talk to, I had to go through this quickly or slowly. So this being MIT, we're going to whip right through this. If you don't know what options are, Bob was never here. We have a rich market in equity derivatives. And the amazing thing is that we can use the prices in that market in ways we haven't used them before. The market, just a little primer on how that market works. The Black-Scholes-Merton model, alphabetically, BMS, the Black-Merton-Scholes model, isn't actually the way people price options in the marketplace. No one really uses that. They have all sorts of more refined models, but it's always used to quote the prices. Prices are quoted by asking, what's the volatility you'd have to put into that equation, the Black-Merton-Scholes equation, to get out the price that you see in the marketplace? And all the usual things hold. The more volatile the stock is, the more valuable the option is. So you have all that sort of stuff. It's not using the formula to price them, it's just using the formula to quote the prices. That's the volatility surface as of October 31st, 2011. And it has some common features to it. It basically slopes upward in time. So if you look, let's see if I can get that. There we go. So as you go further out in time, so that's a 6-month option, a 1.5-year option, 2.5, and you look at the curve right here, it's sloping upward. And basically, it slopes upward as you go out further in time, which just basically says that as you go further out in time, don't be fooled by the fact that it doesn't. I'll explain that in a minute. As you go further out in time, it becomes more valuable. But you'll notice that over here, it's right in the corner, it's way up there. So imagine a sheet that was sloping upward in time, and someone picked up the corner at the left and just pulled it up. That's the skew, or the smile, whatever you want. But that's essentially what the surface looks like. And it changes as the market changes, and it changes with a whole host of different things. And it's going out there 2.5 years. And it's got something out there like 110%. So it says, maybe it's saying that if the market's up 110%, it's up 10% 2.5 years from now. Embedded in that, it must have something to do with the probability that the market thinks that'll happen. If the market thinks that'll happen, the price might be higher. Let's take a look further. The third one is the basic equation. A put option is like insurance. So if I buy a 20% out of the money put on the stock market, then if the market goes down by more than 20%, I get the difference. It's insurance with a deductible, 20% deductible. And like all insurance, it has a price that depends upon two components. One is the probability that that's going to occur. In this case, if I'm talking about 20% decline, it's the probability of a crash times how risk-averse people are towards the crash. And both of those change over time, and both of those have an effect. We can talk about how that comports with option pricing theory, but we want to save that for the questions if you want to ask that. But the more risk-averse people are, the higher the price, and the greater the probability, the higher the price. And a good example is property and casualty insurance after the hurricane. So after Katrina, insurance companies that sold P&C insurance in that area lost a lot of money. But they were, in some sense, they were sort of smiling as they paid it out, because as time went on, they made it all back. Now, there's no evidence that the probability of a hurricane rose in the subsequent years because they had one then, unless you really believe in global warming and sort of intricate things like that. But leaving that aside, there's no real evidence that the probability of a hurricane rose. What happened? People grew incredibly more risk averse, and premiums just rose after the hurricane. And they continue to stay high after the hurricane. That's what happens after hurricanes. That is risk aversion changing, but not the probability of the event changing. Here's the model. No talk at MIT is complete without a model. So a state is a description of what do we use to forecast the market. To keep it simple, let's just say we're forecasting the market based upon its current level, or maybe its current level and its past return. We won't use anything else. And the probability that the system moves from one state to another, I'll label that pi ij. And Andy told me I could use matrices, so pi is the matrix, with pi ij as its elements. So think of the states this way. Maybe the states are, the market's currently at 1380, say. Here's a state, it's between 1300 and 1250. In another state, it's between 1250 and 1200. And just break out the states that way, or higher than 1380. Take the current point as a reference point and take some ranges around it. And those would be the states. And so we're asking the question, what's the probability that the market moves from the 1380 it is today to any other state? That it moves up or down. And P are these prices that I told you about before. This is what I want to know and I don't have. I'd like to have contingent prices. I'd like to know the probability, or pardon me, the price of $1 in the future. I'd like to get a lock-in contract for $1 in the future if the market today is at 1300. It's not, it's only at 1380, so that's one of my problems. I'd like to see a contract that said if the market was at 1300 today, how much would I pay for $1 if it gets to 1400 in 6 months? So I'd like to know those contingent prices. And I can actually find those from the prices I do see today. Now, maybe I should, a little bit of time. I'll go quickly because we're running out of time. That middle equation is just the equation I had before. The price of one of those securities is going to be delta, and that's just the discount rate. There's a time factor here, times the risk aversion, times the probability of the transition, exactly as we did for the insurance before. So what we're going to do is we're going to do and here's just another demonstration of it. So that equation that just flew up at you is the discount rate times a matrix D that has the risk aversions on its diagonal, its inverse times the probability times that matrix again. The bottom line here is more interesting than the arithmetic. That's the probability as a function of those prices. So the D's are the risk aversion and P's are those prices. In the market, I might be able to find out what the prices are, but how can I get the risk aversion? That's the key issue here. How do you separate risk aversion if you only have prices? How do you separate risk aversion from the prices to get the probabilities? Right? Because all I know is that the prices are the product of the probabilities times the risk aversion, so I've got to be able to figure them out separately. Well, there's a wonderful equation, and some of you might know this. This is the Perron-Frobenius theorem. Raise your hand if you don't know that. The Perron-Frobenius theorem says, take a matrix P, and if it's all positive, for example, there'll be a vector x, so that px is equal to a constant times x. And there'll be a unique x that does that and a unique constant that does that. There's only one. It's a wonderful old theorem, and it really is old. You know, it's sort of like what we do in option pricing theory. I was attracted to option pricing theory for a lot of wrong reasons, but I got into it in part because the math was all these partial differential equations, and I sort of liked partial differential equations. And then when it came time to actually solve them, you couldn't solve any of these things. What you would do is you go back to 19th century mathematics, 20th century mathematics, where people like Bessel had solved them for you. And then you could just take those solutions and say, see, this solution is a Bessel solution. I like that sort of stuff. Yeah, so it was easy. I like the fact that these guys had solved all these things. Well, it turns out you can solve this equation, and there's only one way to do it. And that one way is the unique solution for the risk aversion on the one hand, and the discount rate on the other, and the probabilities too. There's only a unique solution to this. So let's do that. So I picked an arbitrary date, April 27th, 2011. And what I'm going to do is I'm going to do all my predictions as of April 27th, 2011. And first I'm going to use the option prices to get these security prices. First, the pure prices. Second step is to get those contingent prices I wanted. And the third step is to apply the theorem and show you what the predictions were at that date. What was the market predicting at that date? Well, the first step is options complete the market. And you'll notice there's a statement for me and Doug Breed and Litzenberger, and we actually showed you how I could do that. So this is an old piece of work, but it's another MIT sort of thing. And what it says is, for those of you in the options market, if you form butterfly spreads, you target in on a particular part of the prices, and you can just get $1 if that occurs, and nothing if it doesn't. That's kind of nice. Here's the range of prices that I got by using the option prices on that day. So I use all the put and call options on that date at all the maturities and all the strikes they give you. And that's what the picture looks like. The picture is more interesting than the table. So on that date, if you wanted to buy $1, and that's the 0 right there, if you wanted to buy $1, and that's very close, say 6 months out, if the market's between 3% up and 3% down, you'd pay a lot for it because it's not going to move much beyond where it is today in that period of time. And you'd have to pay less for dollars further out. And as time goes on, if you were to look out 2.5 years there, or 3 years there, the curve becomes less steep, it becomes flatter, which just says that the chance of things occurring out in the tails is higher. So the price of those things, you're going to pay more for that today. Here are the contingent prices that I derive, and I think the important thing is just to, oop, wrong way. Is this going forward? Yeah. This picture tells you what I want to do. I have the price of $1 today if the market's at 1,600 3 quarters from now, 1,500, 3, 14, 13. So you tell me any price the market will be at, and I'll tell you what the price of a security would be, a derivative would be, that paid off only if the market was over there. What I really want are these prices. The price of $1 if the market's at 14.50 if the market was currently at 1,600. Or the price of $1 if it's 14.50 if it's currently at 1,500. This picture lets me do it. Because what this picture says is if you want to get from today, which is say 1,300, to a year from now, 14.50, in 3 quarters from now, you have to go through one of these places. It's the only way to get to the 14.50. That means the price of $1 when it's 14.50 a year from now is going to be the sum of all the ways of getting there and all the prices for getting there. So without going through the work, that's what it looks like, all those prices look like. And then the last step is, let's just figure out for these ranges, that's the price ranges I took. I just had to pick something, 11 possible prices. And what I want to do is apply the theorem that I said, and I'm going to get for you the probabilities and the risk aversion. And I'm going to show you now, perhaps the only reason to go to the talk. I'm going to show you what it actually predicted at that day. What did it actually say? So this is as of April 27th, 2011. What did it say would happen 6 months later? That's what it said. So let's take a look at that. Look at those two. I think the last 2 columns and the first 2 rows are the most important. Bootstrapping is just taking the historical probabilities. So what does history tell us? Well, if history was a guide, then going forward, as of 2011, April 2011, there'd be an 8 1/100% chance that the market would go down more than 32% in the next 6 months. And there will be a 0.2% chance that it would go down more than 26%. What did this result come out to be? Well, it says that there's about a 1% chance that it's going to go down. Not an 8 1/100%, a 1% chance. And there is a 2% chance, not a 0.2%, but a 2% chance that it's going to go down 26%. I'd really like to see what this was saying around April of 2008. That would be really interesting to know. And here's a picture of the 2 distributions, and that's kind of interesting too. So look at the green one. The green one is what we've gotten from this technique, and the blue one is just history. So the green one says, look how much fatter the tails are. The green one says there's a real good possibility that you're going to be down there in the left-hand tail. There's a high possibility of a bigger loss than history would have said as of that date. Merton Miller had a wonderful comment once after the crash of 1987. And Mert said that was a 20 standard deviation event. So if you were to use The blue thing, which is history, you would say it was a 20 standard. And I said, well, what do you think of that? He said, I don't think at all, because 20 standard deviation events never occur. But it did occur. And in fact, unfortunately, 3 and 4 standard deviations events seem to occur not every 50 or 100 years, but like every 2 years or so. The market's not stupid, it recognizes that. So the green is what I think is implicit in the market. So it's got fatter tails on the left. And where does it pay for that? It's got a lower probability of a big upswing, right? And it's got a higher probability it's going to stay about where it is. Well, that's you can look at that table. That's the risk premium that you get. Here's what I want to do. I want to test this by looking at past data. I want to actually see in 2008, 2007. I want to go back, and every day I want to predict what the market will be going forward. To do this, I need the volatility surfaces. Those of you who work in banks can get these for me. It turns out that exchange-traded options are a very small part of the market for equity derivatives. They're about 10 to 15% of that market. Almost all the action, even on common instruments, is in the over-the-counter market. So we have some of this. Some of this is based on aggregating a couple of banks that are friendly to me. I'd like to compare the recovered predictions with other kinds of predictions. I really want to see if the forecasted crash probability is close to what something that's reasonable. Might that be what had happened? And this is going to point us to new ways of doing things. I want to apply it to fixed income. You can see in the smaller stuff there, I'm doing it with Ian Martin at Stanford. That was borrowed from Warren Buffett's annual report, where in a fit of shame, he wrote in that they had bought a corporate jet. But if you read the annual report, it's in much smaller type than everyone else. So I thought the mention of Stanford deserves smaller type here. And then I want to publish a monthly report of this to just tell, here's what it is. This is what the market is saying is going to happen to returns going forward. So I can't predict the market, but I think what I can do is tell you what the market is saying the distribution of potential returns will be. All right? Thank you. Yeah. Do we have time for questions? Yeah, go ahead. Questions? No question. Yeah.
Regarding that last point, in terms of you wanting to see and publish regularly what is the market saying is the chance of a coming catastrophe or a boom, have you thought about what the implications on the market by publishing that would then be, and is that then going to in some way become some kind of self-fulfilling prophecy? How do you, kind of keep your research and your results external to what actually ends up happening?
That's a good question. I actually don't think that occurs. I mean, after all, I got these prices and I got these probabilities from the market. This was what the market was thinking, and that's how they set the prices. But I do expect that actions will be different because of this. I would hope that large institutions change their asset allocation when they use these numbers, rather than, for example, saying, we think the risk premium is 8%, when it's not, and no one else does. At least they'd have some benchmark they could compare those statements with. So I do hope there are some actions that are taken based on that, but I'm not sure it's going to be a self-fulfilling prophecy. If I could create self-fulfilling prophecies, I probably would. It sounds like a financially successful strategy, actually.
Hi, question. When you were talking, you were saying, I'd really like to know if the market were 1600 today, how much people would pay for the chance it's 1450 in the future. And then when you were going through it, you were going through sort of a future path at 1600 and all the different paths. If you could take just a minute to explain the difference between those two things, or what I didn't understand right about the statement.
Sure. I mean, this is a quick dive into something. People say to me, well, that was very hard. I didn't understand it. I've been thinking about this for 20 years. I worked on this thing for like a year and a half. It'd be very disappointing to me if you all understood it and that sort of thing. So I expect it to be a little hard. All I'm saying is you're going to get to 1,400 out there. I know the price today of getting to 1,400. I can set up a contract, a derivative contract, that'll pay me off if the market's at 1,400 or somewhere close to there a year from now. But what I want to know is all these different places. If the market's at, let's say I'm doing quarters, if the market's at, say, 1,200 3 quarters from now, what does it think? What's the price of going to 1,500 1 quarter later? So I want to know those contingent things. And the only way I do it is I know the price of getting to any place, like 1 quarter, half a year, 3 quarters, a year, and all the way out. And all of those prices, anytime I look at one of them, if I'm getting to, say, 1,400 a year from now, I have to have gone through all these other paths. So the price of getting to 1,500, say, a year from now is the price of getting to 2,000 in 3 quarters and then going from 2,000 down to 1,500 1 quarter later. Plus what it cost me to go to, say, 1,400 a year from now, or 3 quarters. And then, so if I add up all those, I get a set of equations, and I can actually solve those equations if I have enough times. I can figure out those contingent prices. I think they're interesting on their own right. And I would expect people to start to trade some of them, contingencies like that.
They do trade sometimes, just over the counter.
Yeah, I've heard that.
And when we're really punting.
I've heard that. One thing, we're applying this to fixed income. It's striking to me. I always thought the fixed income market, which has, Bob threw around T for trillion and got your attention. Let's throw around, I think it's Q for quadrillion. If you look at the amount of fixed income derivatives out there, the notional value is $800 trillion, rounded up to a quadrillion. That's a large number. But you ask yourself, is it possible to buy a contract that says, if the short rate of interest 2 years from now is 5%, and the long rate, the 10-year rate is 9%, I'll get paid off? The answer is no. You can get close, but you can't exactly get that. Right? It's sort of surprising to me how little there is rather than how much there is. There's an enormous amount of volume in the same thing. Yeah.
Hi, I'm Pete Linder. I was just thinking about the list of possibilities you had for the prices to travel, and sort of reminded me of a little bit like quantum physics, where you sum up all the different ways an electron can travel through 2 holes, and you get a different probability distribution, even though it could only go through one because it's a particle, not a wave. So when Myron Scholes did the initial option pricing model, he came up with the equation that he couldn't solve, and then somebody, I don't know if it's Professor Merton, said, oh no, this is a solved problem by Albert Einstein on heat transmission on a flat piece of metal that you hold the end pieces at a constant temperature. And so that was using classical mechanics. So I wondered if Black-Scholes is using classical mechanics to get a solution, and you are going to quantum physics to get a solution.
No, it would be flattering, but it's untrue. Actually, that equation was solved not by Einstein, but by someone before Einstein. That's an old equation in the 19th century stuff. My teacher wasn't any of it. My teacher was Richard Feynman. And I was his student for a lot of years, and he developed Feynman paths and Feynman CAC integrals. And a lot of what we do is just Feynman paths with different names on them. So when an electron hits something and all these things fly out from it, they go along things called Feynman paths. And he developed a whole science of this. And this could be a homage to Feynman, but I don't want to insult him or his memory, so I won't say that. All right. Okay, thank you all very much.
But I will not take the remaining 15 minutes. I think we ought to close up fairly quickly. But can I just say 3 things? First, you know at MIT we are proud of all the things that were created at MIT in modern finance going back to Modigliani and Miller in the 50s. But we're very proud of things that happened in the late 50s, 60s, 70s, 80s. And that's understandable. but you're also entitled to ask, what have we done for you lately? Right? And so part of the point of the Finance Day was to give some examples of things that are going on now that you should be, if you're alumni, you should be proud of or interested in, even if they're not exactly the classic things that Bob Merton or Steve Ross and I might have done when we were young. Second, you can see some themes emerging from MIT Finance that you probably would not have seen 15 years ago. This emphasis on policy, which has come up several times. For example, the idea of education that is not just focused on either doctoral students or MBAs, but focused on, let's say, the MPhil program, where you have on average, much younger students, but very talented students who we think are not necessarily going to end up as CFOs or traders, but they might very well end up at the CFTC or the Fed or European Central Bank, whatever. I think a lot of these students are going to go into broader, or I shouldn't say broader, but different kinds of finance jobs. I think that's going to happen. And the final theme is just that, look, we're growing. The faculty now is 18, full-time faculty is 18 instead of single digits many years ago. We're now offering 33 different finance courses at MIT versus probably single digits many years ago. And the faculty is expanding, courses are expanding, new programs, so we're growing. And as this event illustrates, we're also trying to reach out to alumni, friends, practitioners, anybody that has an interest in finance and is willing to listen to us and talk to us and connect, I hope, back to MIT Finance. Now, I do want to thank the people who organized this. And I actually tried to go to Kelly Bowen and say, can I have a list of people to thank? And she kept saying, no, 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 there's too many. But you see people around on the staff who put this afternoon together, and I hope maybe at the cocktail reception you'll take an opportunity to thank them. We all ought to be very, very appreciative. Right? Right.